We have 5 important news to report about Tesla today. First, Tesla China just launched a new instant discount of about $1,400 off for those who buys a Model Y by the end of the year. It looks like this deal overlaps with the current 5-year interest-free promotion. Sure looks like Tesla will do what it needs to do to get a record-breaking year-end. We've also got new photos of the Megapack factory that might be completed by the end of the year. You can decide if you think that's going to happen. Second, in a similar vein, but in Australia, Tesla just launched a new Lease My Tesla program. This allows easy access to lower cost leases to boost sales. And third, automakers in the US are continuing to struggle with US auto inventory spiking upwards again. New vehicle inventory is now over 3 million for the first time since the pandemic. That's 85 days of supply, 29% increase year over year. Fourth, new data is showing that after years of spending on electric vehicles and autonomy, automakers are starting to pull back, cutting billions. Finally, Tesla has decided to settle their lawsuit against Rivian, which accused Rivian of poaching employees to steal Tesla trade secrets. Some people are saying, might this be a precursor to an FSD licensing deal? The person we're going to ask this question to is Jeff Lutz. He's a multi-decade supply chain executive and chief quality officer. He's now CEO of his own high-tech manufacturing consulting firm. Thank you so much, Jeff.
Hey, Herbert, lots to talk about here.
So these are, combination of promotions. We're heading into the, fourth quarter, final 2 months here, final month really, and lots of things happening. So you've got Model Y in China. It's 10,000 yen being reviewed here. Tesla Chan does a great job of giving us updates of what's happening in China. Tesla China launched 10,000 yuan instant discount promotion for Model Y. This deal may overlap with a 5-year interest-free promotion. World Best in Car, which is Tesla Model Y for a cheaper price, applies if you receive your vehicle from November 25th to the end of this year, December 31st. Instant discount. It's about $1,380. So these things are happening, Jeff. Why are they doing this, and are we going to get a record quarter?
Yeah, I think we are. But there's a couple of things going on. And we're going to go through some data from the U.S. in a bit. But I mean, globally, the auto industry is not booming by any measure or definition. We'll go through some data points in a bit, and yeah, I see us, getting to a point here. So you've had incentives go on from a financing perspective. All the companies that sell vehicles are doing it, and Tesla finally, started doing that themselves. And they actually have been very quiet on the MSRP front for a long time. So, I view this as, okay, this is a 6-week period to the end of the year. Yep, it is a price cut by any definition. They're cutting the MSRP. You've got to take delivery by the end of the year. But what else is going on with Tesla? What's going on with Tesla is they're most likely in some form getting ready to introduce the new version of the Model Y. And what I see Tesla do better than any auto company, and quite frankly, better than most consumer electronics companies that I've seen, is manage their channel inventory, it's called excess and obsolescence, or E&O. It's one of the lines in unit economics. It's how much parts you have of the old stuff and how many finished goods you have of the old stuff. And if it's excess or obsolescence, you've got a food fight between yourself and the suppliers. And then you've got this stuff on your balance sheet in your factory. You also have product and channel. And what Tesla does better than anybody is they zero that stuff out. And from an economics perspective, from a balance sheet perspective, that has huge implications. At any one point in time, I estimate Tesla has about $12 to $15 billion of material on order. They have, $3 billion or so in cash. But just to give you the idea of the magnitude of any one point in quarter, they're floating a lot of material orders out there for suppliers. And the worst thing you could do is be ordering product that you're not going to convert and build and ship. So what I've been talking about on this show for over a year now, Tesla's low network latency. They have a very short span in their supply chain in time. Okay. They localize their supply chain around their factory. So what is this? Why does this go back to the Model Y again? I think the second reason, first reason is market's competitive. I think you're going to see incentives going up across the board from others as well. We'll talk about it in a bit. And you're going to continue to see this push towards the end to keep channel inventory low. Remember, Tesla left the last quarter with 19 days of channel inventory. They actually increased production by over 15%, but they kept channel inventory in the 18 to 19 day range, and they kept their inventory inside of their four walls in their factories static quarter to quarter, about $14 billion in balance sheet inventory. That's everything to auto, energy, everything. So that's a lot of information, but what I'm trying to tell you in that little short bit of data is Tesla does a very good job at managing their inventory. They have a very low inventory. So part of this Model Y could also be getting everything flushed out and getting ready for the next product, the Juniper. I'm speculating. I don't know.
Yeah. We don't know, but that's why it's so great to talk to you, because there's like many things to think about, right? Whether or not their production is higher, whether or not the competition is higher, whether or not they got more margin, and so they have the ability to do something like this. But like you said, at the end of the day, it's a price cut, and they're going to try to sell as many as they want, and it's complicated, right? It's Tesla, Shanghai, Giga Shanghai. They're just amazing up there, and then there's the cutover to the Juniper. That is what I think it likely is. And I know again, we're guessing, but it sounds like.
And by the way, social media as it relates to commerce in China is different. So we talk a lot on X about, different versions and spy shots and this and that. And China, it's almost like a hive mind. Like their their awareness of potential new versions is what I'm going to buy going to be obsolete is very, very high, much higher actually than in the US. So they may be struggling a bit on the Y to get the channel flushed. We've seen the Model 3 data in China has been exploding the last couple of weeks upwards. So and Tesla China has printed 2 really good weeks, over 17,000 in insurance. That's for domestic China alone, 17,000 in insurance registration. So they're doing well. But I think Tesla has to flush this channel of inventory, and it's quite frankly a competitive environment for vehicles.
Exactly. Okay, we got lots of stories to go move on here. So this is Warren Reglick. I guess he got some information from a viewer. New photos of Tesla Megapack factory in Shanghai. Per my source, the Megapack factory is huge, though not as big as Giga Shanghai. Possible that Cybercab will be produced here. In Giga Shanghai, I guess. About 600 meters from Giga Shanghai. He's got the photos here of the Megapack factory. It's looking like it's pretty well almost complete. I know that 2 months ago they said it was 70% complete, but boy, this sure looks like it's ready to go. Jeff, do you think that this Megapack factory, while they said it's going to happen, it will be in production by first quarter? They said possibly it might even come by December. What's your thoughts?
Well, Tesla in their last 2 earnings releases, Tesla did change the wording to address a pull-in of the Megafactory here. What they had in the Q2 earnings was start of production in Q1. And what they changed it to in the most recent earnings that we got in the 3rd week of October was begin shipping in Q1 to customers. That's a many-week pull-in to go from just being able to just promising the start of production in Q1 versus getting through all the internal factory qualifications to be shipping to customers by the end of Q1. That's already a big pull-in. Could they ceremoniously build a Megapack at the end of December? I mean, it's possible, but I don't think it's meaningful. I would just go off of their most recent guidance, which is they're going to be shipping. What's important is the ramp curve of the factory. Remember, it took Lathrop how long? That's another data point we should be looking at, is how long did it take Lathrop to get to that 40 gigawatt hour equivalent output, and what will it be for Shanghai? So I think so they did do a pull-in, but I think the more important thing for us to watch as viewers, investors, and so forth is the actual slope of the ramp.
Another promotion is happening this time in Australia. Tesla offers lower cost leases in new program to boost flagging EV sales. That's how this article put it. So there's a new program called Lease My Tesla. It's in partnership with another company called Driva, a local finance company. And new leasing program is now available. Tom Drew, Tesla's Australia and New Zealand country director, said, "Today we have taken a huge step towards demystifying novated leasing." I don't know what that is. Novated leasing. Our newly launched Lease My Tesla program allows us to provide a digital-first customer experience and eliminate unnecessary fees and complexity. Makes Tesla vehicles more accessible and affordable. Tesla for years been a dominant force in the EV market in Australia and in its home market in the US. But in October, for the first time, Chinese maker MG4 took top spot as sales of both Model Y and Model 3 continue to flag, with overall Tesla sales down 20% from the year 32,214. So this is how they positioned it. They think that a new lease program is now available.
Yeah, this is a third party thing. This isn't Tesla, but Tesla did make their lease pricing in the US. First off, lease rates are very low, low single digits. And Tesla did make their lease program on the Model Y more attractive in the last couple of weeks. And I saw some people post on X like, "Oh, this is disappointing. This is a big, price reduction or something, 6,000." I'm like, what are you talking about? Like, when you look at a lease, I mean, I think you could take the bearish side of it, and that's fine. That's a viewpoint. The other side of it is Tesla could be seeing prices stabilizing and the expected value of the vehicle over its life growing. And that's the really important thing of a lease. You can get a huge bullish signal out of that, of Tesla doing that and saying, all right, we can allow it to be a little bit lower up front because we think the expected value of the vehicle over time. Remember, these things are going to come off a lease in 2 or 3 years. What's Tesla going to have in 2 or 3 years? Robotaxi network. So I view it as actually a bullish signal if Tesla can increase leasing. This is something that's been kind of low for them up to this point. So I read the situation with people are doing this very differently, but this Australia thing looks like a third party thing.
Yeah, it's a third party thing. Okay, so this next two stories are very big, important stories for Tesla investors to understand. Jeff, if you follow him on X, you will see this is the kind of information he follows, and he's tracking it, and he'll explain to you why you don't see this, discussed much by other folks. But basically, the first one is that the auto inventory has spiked significantly. It's now over 3 million since the pandemic. This is much higher. And the second story is that you'll see that these large automakers, they are cutting back billions of dollars in spend. So let's address that first one first, this new inventory. Again, this is the things that you'll see from his X account. Few people is actually following this except for Jeff. So US auto inventory spiking upwards again. The pandemic high was 3 million cars in dealer inventory. This is where we're back to that, which is really odd, right? Because obviously the pandemic was a very special scenario. Why are we back up to 3 million cars of inventory? That's 85 days of supply. That's 29% year over year. Cox Automotive, new vehicle inventory tops 3 million. Basically the things you were saying, average listing prices have stubbornly remained above 47,000 for more than 2 years.
Yeah, it's complicated. There's a lot of moving parts. They try to make it overly complicated. We'll try to demystify it here. So that inventory levels, how you get to the 85 days, they're looking at the SAR for the year, and they're saying, all right, it's actually grown. It started the year at 16 or so, and then it dipped to 15.2 million vehicles for the United States. For the year, that's the estimated retail sales, and now it's back up to 16. So if it was back down to 15, that the 85 days would actually be much higher. So what's the point here? What's happened with days of inventory in the US? And I should have included a graph, but it actually spiked to between 100 and 120 days in June and July. And we're like, hey, what's going on? Well, we had this cyber attack on all the auto dealerships and all their transaction and processing systems. And that actually did slow some sales and cause some issues. And then they recovered. And then the auto industry had a big month in the US in August. And all of a sudden they got the inventory down, I think in the low 60s. Everybody's like, okay, everything's pretty good. Well, I think the more concerning thing now is to go and dip into the low 60s and now go back up to 85 days. The auto industry, the conventional auto industry, the non-Tesla, I would say, that's where they they ship from their factory and they go into a dealer network. It's 85 days is dealer network inventory. They will tell you that they're targeting somewhere between 45 and 50 days or so of inventory. That's what they want for a healthy channel, so people can go and they go to a dealer, they want to buy a car, it's basically available and they're not having stock outs and long waits. So they'll tell you that they're targeting 50, which if you just think about it from a supply chain perspective, Tesla is targeting something probably closer to 20, or under 20. Maybe it's in the, call it 15 to 25 days of inventory. And if you look at the way they design, they're targeting 45, 50. I think the thing for viewers to understand is the relative movement is kind of big. To go from the low 60s in days of inventory in September to now in the first couple of weeks in November, the reading is now 85 days. We have to watch this trend line and see what it does. 85 days is a lot. It's 29% higher versus where it was a year ago. And this is where it gets really important. When you see, in October, and you see all the auto companies report their sales of like, oh, sales are up, 8% or 9% year on year. If you're increasing your inventory levels in aggregate by 29%, they count a sale as leaving the factory and going into dealer inventory. So if your dealer inventory is going up 29%, but your sales are only going up 5%, 10%, in the case of Stellantis, they went negative. Their sales went in reverse. I think Ford was pretty much flat, maybe just up a little bit. But you got to look at the relative inventory levels. If they're drawing down inventories and they're still above their level they want to be at, that's a good sign. But when they're actually adding to their inventories in the dealer network, and their percent of sales growth is lower than what they're adding in dealer inventory, that tells you that that's actually a problem. And so you have to look at these things over multiple data points and connect multiple months together, because sometimes you could have a one-off issue. But that's the thing to watch. Finally, I did do a couple of double clicks into this. And what this 85 days represents is the dealer network. These companies obviously have many, many factories. In fact, they have a ton of factories. They have too many factories. And they're highly underutilized, by the way. I looked at, I went and double clicked in the GM, because GM was reporting an increase in sales from Q3 of 23 to Q3 of 24. Yeah, we see, their dealer inventory is actually pretty consistent between those two periods. So they're not the big contributor, by the way, to a lot of this increase, at least year on year. But I looked at their balance sheet inventory, and their balance sheet inventory is the inventory they carry in piece parts and finished goods in their factories that haven't been converted to final product and shoved out the door to the dealers. And their balance sheet inventory went from 35 billion to 40 billion over that period. So that's about a 14% increase in their balance sheet inventory. Remember, I was just earlier, I was telling you about Tesla, and they were able to increase their production Q2 to Q3. Their channel inventory remained constant and their balance sheet inventory remained constant. And here you have GM, minor increase in sales, big increase in dealer inventory in aggregate, and their balance sheet inventory increased, 14%. So keep an eye on these things. These companies aren't impervious. They're pretty big. They haven't pulled the incentive. They're starting to pull the incentives lever. That's the thing you don't see in that $48,000 transaction price. So there's many moving parts in this, but I think to summarize the key takeaways, inventories in the dealer network are going up. On a couple of double clicks, just looking at the balance sheet inventory of these companies, they're going up. This is something to keep an eye on, because what it would drive is they would drive incentives, and it would drive the total transaction price to be lower. So this is something to keep an eye on. And it's also something to keep an eye on for their cash position as well.
This is great, Jeff. This is exactly the kind of information that only, you've been saying for quite a while. But if people just look at these automakers and they look at their sales and that's all they're tracking, they have to track inventory. And that's how you know whether or not they truly are. And this is, you're looking at the relative increase over time and you're following it. So thank you for explaining all of that. This next story you also shared and thought that this was really important. we've got this information here that the auto industry is pulling back on its capital junkie tendencies. So basically, they started to increase, and they needed to spend a lot of capital, cash, R&D to build self-driving and electric vehicles. But now they can't do it anymore. They're cutting back. After years of spending capital freely on all electric and autonomous vehicles, they're starting to pull back. It takes a significant capital investment every time an automaker launches a new product or updates current models, causing a spending ripple effect throughout the global supply chain. Now GM and Ford are cutting billions of fixed costs, including laying off thousands of workers, while others such as Nissan, Volkswagen, Chrysler are talking about, or Stellantis are talking to taking even more drastic measures to reduce headcounts and trim spending. So this is massive. Let's take a look at the actual, I'm going to jump here to the actual table. The research and development and capital expenditures totals for top 25 automakers. This is from 2015 to 2023. So in 2015, they spent $200 billion. And then you can see that's kind of rising over the years. Now $266 billion. That's what they did in 2023. But now they've cut it. Where do I see the cut?
Well, they're cutting now. They're cutting now. And what's interesting, Herbert, in that graph is that if you look at the US, for example, the number of total vehicles shipped peaked in 2018.
Right.
So you've got 200, this is what companies do. They look at you've got $234 billion in spend, and you've essentially increased it by 15% going into 2023, but you're not shipping more vehicles. And you're over a 6-year time horizon. Your R&D hasn't paid back in terms of, the cost of those vehicles have gone up, and so their sales have gone up in gross, aggregate. But in terms of, unit output, that hasn't gone up. And quite frankly, they're not, the big thing for them, the big premise of this whole article is they're not getting the ROIC, return on invested capital, or return on invested R&D is another one to look at. Either way, they're not getting the return on electric vehicle development that they put in. And what's happened also, we've had an election. And so the political climate has changed as well. Rewind the clock 4 or 5 years ago, everybody's, gung-ho and saying we're going to do everything EV. And then all of a sudden you see the Department of Energy, and you see this bazooka money going out in loans and grants, and everything's happening. We're going to build a factory here. We're going to build a factory there. But they never had the vehicle design that had the proper unit economics that could even scale at very low volumes. And people are like, well, they just need to get to higher volumes. No, if your unit economics are fundamentally broken, even getting those to scale, you would just accelerate your losses, and you would just add to your losses. And that's what Ford and GM realized. So that's why you saw them over the last year. They reduced their CapEx. They reduced their supply of electric vehicles. That's the other big thing. They built a bunch of product. They built $67,000 Lyrics. They put them in inventory. Then they got 200 days of 200 days of inventory across many of these EVs. And then, now you've seen this pullback, and now you've seen the political climate change as well. So you're going to see all this stuff pulling back. And it's going to be interesting to see between the political world, because you've had these investments in all these congressional districts, all these senators, and now you're going to have these companies that are not executing on these investments. It's going to be interesting to see. They've crafted this narrative of the people want hybrids. And I'm sure there are some people that want hybrids. It's fine, build those. But people want EVs as well. And if you could, trust me, if Ford and GM could build a $30,000 EV that looked really good, that they made money on, they'd be building those EVs, and they'd be shipping them everywhere. They'd be setting up factories everywhere in the world. You see the growth in China in EV. You see the growth all over the world. They would be doing it. They're not doing it. They're pulling back on their investments, which is the point of this article. And I think they've really got to look, and they've got to really figure out, are they doing everything that they should be doing to relaunch and to build this next generation of vehicle profitably? They've got to change how they develop product. They have to fundamentally change their development process, what they do inside versus what they farm out. They've got to redesign their supply chain. And then this is not even talking about the preparation for autonomy. and how are they going to get to autonomy? And they both, Ford canceled their Argo investment on their pure play autonomy platform. They killed it. And then we've seen publicly GM pull back on the investments in Cruise. They say they still are. So it's interesting. They're pulling back on these investments, and this is an article, but the next tidal wave, this is a puddle. The next people are talking about the $7,500 credit. That's nothing. This is nothing. When we zoom out, we're going to be 5 years in the future, and we're going to look back at this point in time. The tidal wave that they're missing now, they missed the EV tidal wave 5 years ago. The tidal wave they're missing now is autonomy.
Thanks for pointing that out. So they are forced to spend more money, but their sales are not coming. So this is all top 25 automakers from 200 billion to 266. That's a huge jump in requirement. Now, when you look at it from percentage of revenue, it still looks pretty okay. But in terms of individuals, like cost for GM increased 62% during that time to 20 billion, despite a 38% drop in sales. You just said that peak EV ICE cars was 2017. That compares with other increases during the time frame of 42%, 37 for Volkswagen, 37% for Toyota. So everybody had to increase in costs. But even Rivian and Lucid have been burning through money. So this will come to an end, or like you said, they need to keep spending money, but they need to solve it fast. So
yeah, this is a scary time. I'm just trying to look up Tesla's R&D. It was at, so Tesla's 4.36 billion in annual R&D on sales of 105 billion. So Tesla's under 4%.
4%.
So you saw those figures?
Revenue. Yep.
Yeah.
10%.
You saw those figures. They're Tesla's 2.5 times better.
Yeah.
That's a lot. That's a mile.
ROIC,
that's
right?
That's huge.
Return on investment capital is one of the critical things, and that's cash flow. Okay, next
and then percent
here.
of R&D. The other thing is your R&D. What I was just quoting is the R&D spend in dollars ratio to sales. That's another thing that companies look at. Yep. Tesla's very low. Story
here is Rivian. So there was a lawsuit that Tesla filed against Rivian. And now it looks like they've reached a conditional settlement. In 2020, Tesla filed a lawsuit accusing Rivian of poaching employees to steal EV trade secrets. Now they've had a conditional, they didn't disclose specifics about the agreement, but told the California state judge that expects to seek dismissal of the case by December 24th upon satisfactory completion of the terms. And then neither declined. It kicked off in 2020 when when Tesla accused Rivian of an alarming pattern of poaching its employees and stealing trade secrets. Some workers were caught red-handed, misappropriating core technology for its next-gen batteries. Some people, this guy said, is this a precursor to an FSD licensing agreement? who knows what this is about. But what's your thoughts about this?
First off, possibly. I mean, that's not a far off thought, to be honest with you. When you have these, sometimes you settle disputes like this in various ways. There's IP disputes. There's all kinds of disputes. Tesla famously doesn't, do a tremendous amount in terms of kind of IP enforcement. They do selectively, but Elon really talks about the speed of R&D and the speed of the product development process and the speed of innovation to outpace, filing patents. They still file patents and they're still important. But that's really honestly Tesla's focus. And here with Rivian, they probably they could have come together on some sort of settlement. I think they may be partners in the future, and I think it may be related to FSD. Again, where's their investment? And again, even the thought entered my mind too. Like I did want a larger SUV at one point. I was even thinking about, like, should I get a Rivian? I know everyone's gonna be like clutching their pearls, but part of my purchase decision to not actually purchase an R1S is there's no path to autonomy in that view, and I want autonomy. I have switched from my rides. used to be a majority. Basically, I would only use, on FSD 11, I was only using FSD maybe 30% of the time. I've completely switched that. I'm probably 90% of my rides now are on FSD and 10% are I'm actually driving. So it has to be in every car that I purchase. So I know we're straight a little bit off, but in terms of like Rivian, I think they will be a partner, and I think you never know. There could be some connection here in terms of let's settle out. We're working another deal together, and let's just move on. But companies like to send messages too in these situations as well of like, do not do this concentrated poaching, and let's figure out like and definitely also if people are bringing in information or files from a prior company. That's an absolute no. If you're the new company, you've got to really enforce that. I don't want anything from the prior company. I just want what's between your ears.
Sure. Anyways, thank you, Jeff. I mean, this is valuable feedback from you, somebody who's deals with this, have dealt with this, have probably filed lawsuits, got lawsuits, all that. You've been all part of this. Appreciate your comments and knowledge. Thanks, everybody. Follow Jeff on his X account at the Jeff Lutz. Thanks, everybody. Bye-bye.
Thanks, Herbert.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.